Oil executives at the Financial Times Commodity Summit delivered an uncomfortable verdict this week. At least 1 billion barrels of oil are already gone from global supply, and the market hasn't fully priced it in. Vitol CEO Russell Hardy called it the largest supply disruption in his nearly 40-year career, bigger than the 1990 Gulf crisis, in a market with less spare capacity, and most of that capacity sitting behind the Strait of Hormuz. Brent crude briefly touched 120 before easing to around 95, but analysts at Shore Capital warn that the apparent calm masks a deeper risk. A fragile ceasefire, they argued, is being misread as a resolution. The consequences reached Canadian consumers faster than most expected. Canada's inflation rate climbed to 2.4% in March, with fuel costs driving the bulk of the increase. That number revived a debate that many thought was settled. Are rate cuts still on the table at the Bank of Canada? GIC savers are betting they are not. Yields on guaranteed investment certificates have firmed as investors reprice the probability of further hikes. The week's best fixed mortgage rates are now firmly above 4%, and the Financial Post reported that sub-4% fixed rates may not return in the near term. Airlines have been forced to make the arithmetic visible. Air Canada suspended service on 6 routes, domestic and cross-border, that it called no longer economically feasible given jet fuel costs. Air Transat's parent cut flight frequency to Europe and the Caribbean. WestJet raised checked baggage fees by up to $50 on certain tickets, matching a move Air Canada made just 2 weeks earlier. The sequence matters. When airlines simultaneously raise ancillary fees and cut routes, they are not managing a temporary shock. They are repricing for a structurally higher cost base. Canadian auto sales fell 8.2% year-over-year in March. The TSX energy sector raised nearly 2%, but it wasn't enough to hold the index flat as broader growth concerns dragged it lower. The Hormuz disruption, traders at the FT Summit noted, is rippling far beyond crude. Fertilizer shortages, metals processing delays, and logistical bottlenecks are compounding across supply chains that run through the Gulf.
There is a structural contradiction at the center of Canada-US trade relations that the current diplomatic language is not resolving. Prime Minister Mark Carney said this week that the United States does not get to dictate the terms of a free trade agreement. He pointed to Section 232 tariffs on steel, aluminum, and automobiles as clear violations of the existing CUSMA deal, not negotiating positions, but breaches. Canada's new ambassador to Washington, Mark Wiseman, told a parliamentary committee that no date has been set for formal CUSMA review talks to begin. When pressed on why, he offered a measured answer. It takes 2 sides to have a meeting. The practical consequence of that standoff is a quiet but accelerating pivot in Canadian economic strategy. Former Prime Minister Justin Trudeau, speaking at a CNBC event in Singapore, drew the parallel to Bombardier's near miss with Chinese ownership a decade ago. When Boeing and Airbus coordinated to kill Bombardier's C-Series program, China stepped in with a cash offer. A G7 intervention rescued the deal. Airbus eventually acquired a majority stake. Trudeau's argument is that the same dynamic is now playing out in the auto sector. In January, Prime Minister Carney secured tariff relief from Beijing for Canadian agricultural exports in exchange for allowing up to 49,000 Chinese EVs into Canada at a reduced 6.1% tariff rate. That arrangement would have been unthinkable 2 years ago. U.S. Commerce Secretary Howard Lutnick told congressional hearings this week that his department is investigating additional sectors for Section 232 action, meaning more Canadian industries could face tariff exposure before any formal CUSMA talks begin. A Democratic congressman from upstate New York told Lutnick that the tariff regime is pushing manufacturers to extend production lines in Berlin rather than expand in the United States. The irony was not lost on Canadian officials monitoring the hearing. Carney's Trade Advisory Council, which he announced this week, signals that Ottawa is preparing for a prolonged negotiation rather than a quick resolution. The Canadian dollar edged lower against the U.S. dollar, tracking both the trade uncertainty and the broader oil-driven inflation dynamics. BC's refusal to return American liquor to provincial shelves, which Carney has explicitly tied to movement on steel and auto tariffs, suggests Ottawa is prepared to hold that position as leverage rather than concede it early.
2 commodity markets are moving in opposite directions, and the reason for each reveals something about where the global economy is headed. Copper held above $13,200 per ton this week, supported by a supply shock that few anticipated. The Hormuz closure has cut off sulfuric acid flows critical to copper smelting. Around a fifth of the world's primary refined copper supply depends on sulfuric acid sourced through or from the Gulf region. China, the world's largest sulfuric acid producer, announced a ban on exports starting May 1st, compounding the risk. Goldman Sachs maintained its average copper price forecast at $12,650 per ton for the year, even while projecting a 490,000-ton surplus, citing the acid shortage as a sufficient offset. Rio Tinto reported a 9% year-over-year rise in copper production in Q1, driven by the Oyu Tolgoi ramp-up in Mongolia, but the company warned it has limited visibility on how fuel shortages and logistics disruptions from the Middle East conflict will affect the second half. Commodity trader Traxys put a $15,000 per ton target on copper within 2 to 3 years. Gold tells a different story. Morgan Stanley cut its gold price forecast for the second half of 2026 to $5,200 per ounce, down nearly 10% from its prior estimate of $5,700. The revision followed a 6-week sell-off that pushed gold down roughly a quarter from its record high, the worst monthly performance since 2008. Gold has stabilized near $4,700 on the ceasefire extension, but the underlying dynamic has shifted. When inflation is supply-driven and central banks respond by keeping rates elevated, gold loses its traditional appeal as a hedge. It stops being a fear trade and becomes a rate sensitivity trade. Spot gold was up 8.5% for the year as of midweek, but the speculative positioning that drove it to nearly $5,600 in January has largely been unwound. Agnico announced a $3 billion consolidation in Finland's central Lapland greenstone belt this week, acquiring Rupert resources at a 67% premium, a bet that the structural gold bull market justifies building scale now, even as near-term price momentum stalls. The weight of evidence points towards sustained copper outperformance relative to gold over the next 2 quarters, but this only holds if the sulfuric acid shortage persists and the Hormuz disruption remains unresolved. If a durable ceasefire is reached and the strait fully reopens, the acid supply constraint eases, copper supply premium shrinks, and gold, relieved of the inflationary pressure that has weighed on it, could recover towards 5,000. The benchmark to watch: whether China's May 1st sulfuric acid export ban takes effect as announced, and whether Hormuz vessel traffic resumes at scale before then. If both conditions stay in place, copper's near-term floor looks firm. If either reverses, the commodity divergence that defined this week could close faster than the market currently expects.